All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be looking at the impact of monetary policies on aggregate demand. Okay, so this is monetary policies on aggregate demand. And when it comes to your monetary policies and aggregate demand, okay, let's look at a graph over here. So this is your graph, assuming that this is your aggregate demand or aggregate supply in this case, okay, an upward slope. And let's assume that this is your aggregate demand over here, AD0. And let's assume that at some point over here, you have your long range average supply curve, so LRAS or potential GDP. Okay, now when it comes to impact of monetary policies, let's start off with buying and selling of treasury bonds. Okay, so as the governments or as the central bank in this case goes ahead and makes a purchase, he buys bonds, treasury bonds and bills from commercial banks. Okay, what's going to end up happening is they're going to pump money into the system, into the reserves of the banks, as a result of which, okay, the aggregate demand curve will shift to the right. Okay, the aggregate demand curve will shift to the right. As interest rates go down, again, the aggregate demand curve shifts to the right. Okay, now when the aggregate demand curve shifts to the right, okay, we're basically expanding the economy. Okay, so the economy expands. And as the economy expands, you have low unemployment, and increased consumer spending, so personal consumption, as well as capital spending. So capital expenditure by businesses, because businesses will borrow more as more money becomes available in the reserves of the commercial banks, and they will spend more money. Okay, because more money means less interest. Okay, more money, money is inversely proportional to your interest rate. Okay, so interest rate is low, businesses borrow more, and the economy expands. So this is capital expenditure, so CE. All right, and this makes the aggregate demand curve shift to the right, and this is for an expansionary policy. So this is expansionary policy, and it's shifting to the right towards your long-range average supply curve, also known as potential GDP. And the ideal equilibrium point for the aggregate demand and aggregate supply curve would be somewhere over here on the potential GDP, because at this point, the supply meets demand in a way in which businesses are able to produce efficiently and sustainably without putting too much pressure on the resources like machinery and labor. Okay, now, if the monetary policies, okay, are contractionary monetary policies, which means if the Federal Reserve Bank um, buys less of those bonds, or if the Federal Reserve Banks directly or indirectly lower down, or in this case, they would increase the interest rates. If they bump up the interest rates, what's going to end up happening is the aggregate demand will shift to the left. Okay, and this would be towards your Keynesian zone, towards intermediary zone. It will shift to the left, away from potential GDP, which is your neoclassical zone. All right, so your demand goes down, and because of which, okay, what's going to end up happening is, okay, unemployment will go up. Okay, personal consumption will go down because obviously consumers will borrow less, spend less, and invest more. Okay, because interest rates are high, they want to take advantage of those interest rates and withdraw money only when required. Okay, so personal consumption goes down and your capital expenditure goes down, which means business spending goes down. If business spending goes down along with personal consumption, both of these they make up aggregate demand and real GDP, which means if they're reduced, your aggregate demand will be reduced as well, and real GDP will be reduced as well. Okay, which means an economic contraction. This is an economic contraction. All right, and because there's an economic contraction, okay, what's going to end up happening is your real GDP will go down. Okay, your real GDP will contract as well. All right. So this is the impact of monetary policies on aggregate demand. Now, to counter this impact, okay, we have counter-cyclical monetary policies, right? Which means the Fed, they may bump the interest rates up if the aggregate demand curve is too high. Let's say it goes over the potential GDP, at which point you have inflation. This is inflation. Okay, and if the aggregate demand is too low, say for example, right over here at this equilibrium point, and assume this is your aggregate demand. If it's too low, if it's below your potential GDP, you will have a recession. And to counter the recession, the Central Reserve Bank have counter-cyclical monetary policies, which basically lower down your interest rates. And to counter inflation, okay, their strategy is to bump up your interest rates. So that way, consumption goes down, demand goes down, back to your potential GDP. Okay, and that would be it for this video. On behalf of B Electronics, this is Obey. Have yourself a great day.